Welcome back, everyone. Sean Stevens here again with Broker to Banker Consulting, where our goal is to assist you with climbing the mortgage banking ladder. As a quick recap, in part one of our Warehouse Bank series, we discussed key questions to ask which involved warehouse bank associated costs, principal curtailments, net worth, and other qualifying requirements. In part two, I then provided additional considerations for you to be aware of at time of initial application or upon renewal. In today's post, we will wrap up our Warehouse Bank series by providing some additional answers to commonly asked questions, as well as review key points from the administrative side of the process that can be a significant value add to a mortgage banker's efficiency. If you've not yet done so, remember to take advantage of our complimentary 30-minute initial strategy call where we analyze your situation and discuss whether a banker transition process is right for you. During this call, we will provide practical expertise and understanding of the loan process for mortgage licensing, investor approval and relations, warehouse bank selection, third-party fulfillment providers, E&O and surety bond companies, origination strategies, coaching, consulting, and more. How many warehouse lines should you have? This is one of the most common questions I receive. And as you can imagine, there is not a one-size-fits-all type of answer. First off, you have to review your own internal production metrics. For example, are you producing in a high-cost area where loan amounts are significantly larger, or in a region where loan amounts are smaller and you are more focused on units? Will the warehouse line cover just your personal production, or do you have multiple branches and MLOs to consider? Once you are able to determine the volume metrics, then you can back into how much warehouse capacity is needed. However, even if one warehouse line could fulfill your volume requirements, like lenders, warehouse lines have overlays as well. For example, as recently discussed, the Exodus Sprout and FGMC have caused havoc in the non-QM space, which also includes warehouse line providers. If you are funding non-QM loans or any type of specialty product, it is good practice to have multiple warehouse lines in order to absorb any overlays that may be put into place by one versus another. Another example of this occurred at the onset of COVID-19 in 2020, where warehouse lines were placing arbitrary minimum credit score cutoffs. Where one warehouse line could have had a 650, another may have had a 640, or yet another may have had no minimum overlays at all. Having a backup plan and alternative options should always be a top priority. Ask what warehouse lending system will be utilized. Make sure to also find out what type of system your warehouse bank is utilizing on the back end. Ask to see if they can provide you with a demonstration of the reporting features. Are there any built-in efficiencies that will help your day-to-day workflows? For example, will it provide 1098 year-end reporting options? Also, how easy is it to navigate if you need to create reports for loan benchmarking or financials, which includes both audited and unaudited? Now, how will you get paid once a loan has been purchased? First off, prepare to have a separate bank account through the warehouse line. This can be termed an operating account or a pledge account. It may require that the mortgage banker maintain a certain account balance or no minimum balance. Make sure to check on these types of details. Once a purchase advice has been provided and the loan has been purchased, the warehouse bank will deposit proceeds into the account. However, if you are utilizing a separate operating account for your banking, that is one outside of your warehouse bank, make sure to find out in the beginning how you will be able to move the funds from the warehouse lender established bank account to your company's main operating account. Will they allow for wires, transfers, ACH? Also, will the warehouse line bank system allow you to link to any online accounting software? This provides the mortgage banker with the added efficiency to delegate the financial and accounting aspects to a third party by providing them authorized access to the accounting software real time. And remember, you can then take the next step and use these connections to automate and build out your loan benchmarking models, which are critical tools to help maximize revenue by understanding your true cost per loan. Now, wouldn't it be nice if there was a blueprint available that would walk you through the steps on how to climb the mortgage banker ladder? Well, that is where we step in to help with our practical expertise and understanding of the process, from mortgage licensing, investor approval, warehouse bank selection, third-party fulfillment providers, E&O and surety bond companies, origination strategies, coaching, consulting, and more. You can simply use our online scheduler to select a convenient consultation time and let us show you the path to prosperity.